Welcome. Today, we're diving into a key tax strategy, one that's specifically for the executor of an estate. If it's used correctly, this powerful provision in the Income Tax Act can really unlock some significant tax savings.
Look, being an executor is a huge responsibility. A central part of that role is filing the final tax return for the person who has passed away. And this can get pretty complicated, especially when you're dealing with income that was earned but wasn't actually paid out before the time of death.
So, to help you navigate all this, here's our plan. We'll start with the executor's main job, the final return. Then, we're going to define this really crucial term, rights or things. After that, we'll explore the tax-saving advantage it offers, walk through a practical example, cover the filing rules, and wrap up with why getting professional guidance is so important.
Okay, let's begin with the absolute foundation, the terminal tax return. This is really the starting point for every single estate tax consideration.
So this return, it has to account for all the income the person earned in their final year. But, and this is the important part, it also has to include the value of a very special category of assets known as rights or things. This is exactly where things get complex. And, frankly, where the opportunity for tax savings really begins.
All right, let's get right into the core concept here. Understanding precisely what qualifies as rights or things is the absolute key to using this tax strategy the right way.
The official definition really hinges on one word: entitlement. We're talking about amounts the deceased had a clear, legal right to receive, but simply hadn't been paid yet. If they had lived, this money would have just been regular income. The key distinction, as we're about to see, is between this clear entitlement and money that was just sort of accumulating over time.
This comparison provides some fantastic clarity. You see, rights or things includes items where the right to the money is crystal clear. Think an unpaid salary for a pay period that's already finished, or stock dividends that were officially declared before death. Now, what's excluded are things that just accrue day by day, like interest in a bank account. That kind of income has to be reported on the regular final return.
So now let's see how this distinction translates into a really powerful tax-saving strategy. The Income Tax Act actually gives executors an option that can completely change the estate's final tax bill.
So how does this actually work? Well, instead of lumping all the income onto one single terminal return, an executor can choose to file a separate second return just for the value of these rights or things. This one choice can dramatically reduce the total tax the estate has to pay.
And here it is, the primary benefit. By filing two returns, you get to claim certain key personal tax credits, like the basic personal amount and the age amount, in full on both returns. You're essentially doubling up on these fundamental credits, which can lead to some major tax savings, as long as there's enough income on each return to make use of them.
And the strategic advantage doesn't even stop there. Another whole group of deductions and credits, things like medical expenses or charitable donations, can actually be split between the two returns. This gives an executor incredible flexibility to allocate them in whatever way is the most tax efficient.
However, and this is very important, it is crucial to understand the limitations. Certain major deductions, like the capital gains deduction or deductions for RSSP contributions, are restricted. They can only be claimed on the regular terminal return, not on that optional rights or things return.
Okay, theory is one thing, but a practical example can really make the benefits shine. Let's walk through a scenario that involves the strategic allocation of medical expenses.
So, let's imagine the deceased had $9,000 in medical expenses. Her income is split, you can see, with most of it on the final return and a smaller amount on the rights or things return. The executor's goal here is to claim those expenses in a way that generates the largest possible tax credit for the estate. This table really shows the optimal strategy. The medical expenses are split between the two returns, proportional to the income on each. But here's the crucial detail. The income-based reduction, which is 3% of the total net income, is also split proportionally. By doing this, the estate avoids having that entire reduction hit a single large claim. The result? A total credit of $7,800, which is a significantly better outcome.
All right, now that we've established the strategic benefits, we have to turn to the procedural rules. Sticking to the correct deadlines and understanding all the options is just non-negotiable.
The filing deadline here isn't just a fixed date you can circle on a calendar. It's actually tied to the Canada Revenue Agency's processing of the main terminal return. So the executor has to file that return first, wait to get the notice of assessment back, and only then can they file the rights or things return. The deadline is the later of two possible dates, either 90 days after that assessment is mailed or 1 year after the date of death.
Now, there is another strategic option on the table. An executor can actually choose to transfer the rights or things directly to a beneficiary. If they do this, the estate itself pays no tax on that income. Instead, the income gets reported by the beneficiary in whatever year they actually receive the payment. This effectively moves the tax liability from the estate onto an individual.
As you can probably tell, the rules are nuanced, the calculations can get pretty complex, and all of this brings us to our final, and I would argue, most important point. This direct advice from our source material really can't be overstated. The decision on whether to file this special return, how to split up the credits, or maybe whether to just transfer the assets to a beneficiary, all of this involves multiple variables and requires some very careful analysis.
For the average executor, this is not a do-it-yourself task. To unlock the full potential savings while making absolutely sure you are in complete compliance with tax law, the guidance of an accountant or a tax specialist who really knows their way around estate matters is absolutely essential.
And we'll leave you with this final thought. For anyone who is acting as an executor or even just planning their own estate, understanding this provision is critical. A simple conversation with a professional could uncover some significant opportunities to preserve the value of an estate for the people it's meant for, the beneficiaries.